Hello everyone, my name is Kenneth D'Souza and I'm the head of pre-sales for Treasury at Intellect Design. I want to extend a very warm welcome to each and every one of you for taking some time out to join me in this discussion and dialogue on digitalization of Treasury. So what are we going to cover today? Let's start with some emerging trends in Treasury and how these trends are impacting digital transformation of the Treasury. We will then look at the future of Treasury, and then we will sum it all up and see how all of this adds up to a positive impact on the top lines and the bottom lines of the bank. Let us start with some of the trends that have been emerging in Treasury. The first one is liquidity aggregation. We have seen of late that there has been a tremendous focus on flows. What banks are increasingly asking for is a focus on FX flows, getting more business basically from branches and corporate customers. Then there is the issue of liquidity pools, which honestly are too many. There are so many liquidity providers, and it becomes difficult to get the most optimum rate for the Treasury from all these different liquidity providers. Banks now want to be assured that they're getting the best rates, assuming they have limits with all these liquidity providers. And then comes the question of distribution. Is it possible to further distribute the best rate, which they have got from all these liquidity providers? I'll call it the optimum rate. Can this rate then be subsequently distributed to their branches or to their corporate clients? Of course, they will want to add a margin over and above the optimum rate which they have derived. Is this possible? Can this be done? This is a key theme that has been emerging across Treasury, especially in banks. So, just to summarize, you have multiple liquidity providers like Reuters and Bloomberg. You have single site portals like Barks and Autobahn and City Velocity. How can a trader on the FX desk be assured that he is getting the lowest of the ask rates if he's buying? A simple rule, a simple algorithm, but how can he be assured without having to look in 5 different places at the same time, be assured that he's getting the best rate? Liquidity aggregation is all about ensuring that the dealer is in fact getting the best rate, able to then add a margin to that best rate, change the margin accordingly, depending on who he is further publishing this rate to, whether it is his or her branch clients or whether it is directly to the corporate customers. Let's move to the next one. The next one is blockchain. This is another emerging trend that has taken the Treasury world by storm. We all know what blockchain is, and we all know that it has the 2S advantage: speed and security. But let's look at the 2 most often asked use cases for blockchain. The first one is SWIFT. Banks are increasingly asking for a replacement for SWIFT. Can blockchain be used as a quicker and a cheaper alternative for international transfers? And the next one is insta remittances, or remittances that are done instantly. Now, surprisingly, this requirement has also come from non-banking financial institutions who are keen to offer insta-remit facilities to their customers. So the question now being asked is, and the trend that we are seeing is, can we use blockchain as a replacement for SWIFT and as an offering to non-banking financial companies and their customers as an insta-remit facility. Now, because blockchain has the facility of speed, it is very, very secure, surely it can. And the biggest advantage of using it is it brings about a massive reduction in the overall cost. Let's move to the next emerging trend, which is tokenization. Now, the main focus here is on bonds and specifically on government bonds and gilt-edged securities. Now, this entire focus on tokenization is being asked why? Because it will speeden the settlement process. So your settlement times are reduced drastically. It also reduces the issuance time. Now, since it is backed by cryptocurrency, it will bring in an element of high security, and the entire framework is decentralized. So if you put this all together, you are reducing your complexity of the trading process by increasing your settlement speeds, by increasing or reducing rather the issuance time taken, and bringing in an element of high security. The other main ask coming out of tokenization is fungibility. Now, why is fungibility being asked for? And the main reason is because participants in the bond market, they want to buy bonds in cryptocurrency, but they want to settle it in fiat currency. Now, you may ask, why is this happening? It's largely because they want to manage liquidity across both these pools, the cryptocurrency liquidity pool as well as the fiat currency liquidity pool. So this could help them with intraday liquidity. It could help them with liquidity in the short-term time buckets. But the biggest advantage of fungibility is you are getting a bond in tokenized format, you are paying in fiat currency and vice versa. So we have seen some of the emerging trends in Treasury, but how do these fit into a broader perspective of Treasury transformation? So to answer this, let us look at a more practical approach to Treasury and the transformation of Treasury. The first thing it calls for is a rock-solid Treasury base. This means that the basic asset classes, such as FX, money markets, fixed income, are all seamlessly flowing in terms of deals from front office to back office in real time. And it then proceeds with your management of limits as well as managing the back office processes all in real time. Now, this rock solid Treasury base allows it to be flexible, which means that as we saw in liquidity aggregation, it can bring in not just a few deals, but thousands of deals from different liquidity pools. It can bring in new asset classes, and it can also have a very friendly and flexible trader UI UX. So there is a lot of talk about UI UX, but a good treasury system with a very standard set of asset classes should primarily ensure that the trader is comfortable entering the deal. Now, most of the deals flow in automatically from these various trading platforms. But what if the trader has to manually enter a deal? How quickly can he do it? What are the number of buttons he has to press? How many times does he have to hit the enter button before the deal actually gets processed? And this is what we mean by a strong treasury base. It is ensuring that all the core asset classes are already in place, that the deal is seamlessly flowing from front to back. All the various instruments under these asset classes are covered. It should be flexible, it should be scalable, and it should offer a very trader-friendly front end. Now we come to the second part, which is flexibility, and I'll delve a bit more on this. Now, this involves actually having an engine that allows you to create compliance rules, dashboards, reports, and even your regulatory reports. It could help you with the creation of risk analytics pretty much on the fly. Now, normally these things take time. On the fly is a sometimes an over abused statement. So what we need to put in perspective here is that the system has to be flexible to allow an end user to create these kind of reports. It could be risk analytics, it could be regulatory reports, it could be compliance rules in the middle office, or it could be just simply creating a dashboard that the dealer wants to see when he starts his or her day in the dealing room. And then we take it a little bit forward here and we say that real transformation is when the screen itself lends a sense of ease to the trader and allows the trader to flow the deal from front to back. Now, what this means is that the deal should be so easy that the screen on which the trader is dealing allows the dealer to make decisions quickly, to analyze the data quickly, and also to facilitate the processing of the deal very, very quickly. And by quickly, I mean real time in this case. We then move on to time to market. Many banks are asking for new products to be created within the Treasury system and to be offered to their customers very quickly. Normally, an implementation process takes close to about 3 to 4 months. Now, banks are asking for implementation timelines to be reduced drastically. So, if a Treasury system has a very strong base foundation, is very flexible, then it should not be a problem to offer a new product within that Treasury framework to the bank's customers. And we call it testing trauma. Why does it take so much of time to offer a new product to a banking customer? It's because a lot of time is spent on testing. Now, the faster it hits the market, we know, the more the returns for the bank and the quicker the returns for the bank. The more time spent in testing trauma, then it will delay the onset of returns for the bank. So quick time to market is all about bringing in new products, ensuring that these new products are properly configured in the system. I use the word configured and not customized because it's now all about just selecting the right menu, the right drop downs without having to touch code. And of course, pushing these new products quickly to the market. Now, technology is the backbone of Treasury transformation. No digitalization process in Treasury will ever be complete without adding the latest technology. Now, latest technology, again, has a lot of uses. We've seen robotic process automation in the back office. We've seen artificial intelligence, machine learning in liquidity aggregation, which we've already talked about. We've also spoken about rate distribution. There is metadata as a use case for predictive analytics. And then, of course, there is platformification. Let me spend a little bit of time on this. So, why do we talk about AI and ML in liquidity aggregation and rate distribution? Because this is a classic use case of bringing in advanced technologies, the latest technologies, a whole set of rules, a whole set of algorithms, and allowing the engine to process these new rules, these new inputs from traders into a whole set of cognitive logic that will allow the dealer to make a decision faster with a new rate, which is far more optimized than the previous rates that he was getting. So what this means is AI, or artificial intelligence in liquidity aggregation, can teach the machine to learn the entire process of buying at the lowest possible ask in such a way that it always ensures a minimum profitability on the deal or a minimum margin on the deal compared to what the dealer was getting before AI was put into place. And this again increases the efficiency of the trade. It also increases the margin on the trade. I'll just jump to rate distribution. AI in rate distribution adds a whole new dimension. You can bring in a whole set of cognitive rules and logic to process the dissemination of FX rates. And why just FX? It can go beyond FX to fixed income rates, to money market rates, loans and deposits. All these can be published to corporate customers or to bank branches. And it can ensure that any sudden changes in the market can also be adapted to without the intervention of the dealer. So things like a change in volatility, a change in the number of times a customer is hitting a particular rate, or just plain skewness of a particular bid or ask rate. All this now does not need the manual intervention of a trader. It can simply use AI to make the trade a lot more cost effective, if not a lot more profitable. And then there is platformification. The world over, Treasury is now all about platformification. With cloud coming into play, most of the Treasury platforms are available on cloud, but platformification is going beyond being available on cloud. It's about, and I'll talk about it very soon, but it's actually about ensuring that there are certain ways in which a bank can get specifically what the bank wants in the way the bank wants it without having to have a major systemic overhaul. And what I mean by this is coming up now in terms of point solutions. So let me explain. We have certain point solutions like branch FX, which is simply the distribution of FX rates to branches. So we have branch FX, which is simply disseminating FX rates to branches. But why do we have to just include FX only? Why not fixed income rates? Why not money markets like deposits and loans? All of this can be pushed to the branches, but the entire Treasury system does not need an overhaul. It can be just a simple module. It can be on cloud. If you're talking about platformification, and it can be paid for using disruptive pricing. So disruptive pricing now is playing an important role in all these platformified solutions that are now being available on cloud. One of them, of course, we've just discussed is branch FX. We then have MT to MX conversion, which is part of the Swift offering. We have intraday liquidity, which can be sold as a standalone solution. We also have LIBOR to RFR conversion. We all know that RFR is the new standard now for rates. LIBOR is no longer being accepted for new contracts. And all of these are standalone solutions. And the theme here is coexistence. So banks can buy these standalone solutions without having to change their Treasury solutions or without having to even overhaul their existing solutions. One classic example is LIBOR transition, where if you move from the LIBOR rate to the RFR rate, you have to change or rather upgrade, assuming that you're using a legacy solution. You have to upgrade your product processors such as core banking, such as Treasury itself, your loan origination systems or loan management systems. And the fourth one is trade finance. I think I've covered it all. Now, imagine upgrading 4 product processors just to change the rate or to accept a new RFR rate from LIBOR. That would be tedious, it would be complex, very time consuming, and also very, very expensive. What if there was a solution available on cloud, which was platformified, which means that it can give you disruptive pricing, which is pay per use, you don't have to pay a lot up front, so it doesn't hit you on the capital cost side. It can also help you with a lot of flexibility, and it does not require a massive systemic overhaul. So, putting this all together, transforming Treasury now is not just about changing the Treasury system. It's about changing the way we look at Treasury. It's not just about making money, it's about how we make money. So where does a Treasury transformation take us? It takes us to Treasury in the future. And what does the future hold for us? Let's look at a few things. So, we've spoken about liquidity aggregation as a key emerging trend, but today the demand is for FX as an asset class, as a product on a liquidity aggregation solution. But this will stretch across all asset classes and will also, in the future and in the near future, include crypto assets, which will feature in the algorithm that allows you to get the best or the most optimum rate. In fact, a lot of service providers are already providing the solution as part of their offering. Then we come to tokenization. Again, it has started with an initial interest, I would say, in government securities. It will then extend to all types of bonds, the variants on those bonds, and even to structures with tokenized underlying. Then there is AI and ML. I've already spoken about how AI and ML can be used in Treasury. And I must say that traditionally, Treasury has been slow in adopting AI and ML. Really, it is very difficult to replace the trader, the skill of the trader in the Treasury. But having said that, AI and ML can make life easier overall for the entire Treasury and not just for the trader. And we have seen some examples where we can use AI and ML in liquidity aggregation, in rate distribution, and also in intraday liquidity. We then move to metadata. Now, we've seen a lot of use cases, especially in the field of predictive analytics. It's also being used in risk modeling. And in the future, we'll see a lot of sentiment-driven trading incorporating the use of metadata. Another interesting trend we will see in the near future is platformification. I've already mentioned that there are no more elephants in the room. It's not necessary to change the entire Treasury. As a platform, Treasury and its various modules can be available on cloud, can be made available with disruptive pricing that doesn't really, burn the pockets. And it also comes with a very readily integratable package that involves a lot of point solutions where you don't have to change or overhaul the entire system that you're using currently. And of course, there is technology. So this allows the trader to feel the trade in advance before he commits to the trade. This is nothing but in the future, we are going to see pre-investment testing of multiple scenarios, probably with a little help from AI and ML, and also from a bit of metadata maybe, which will allow a dealer to check how this will impact his various positions, how this will impact his risk, to check different types of scenarios, and also to validate the workflow results, including complex risk analytics. So where does this all take us? It takes us from the future to the present. And the present is all about the top line and the bottom line. So at the heart of digitalizing Treasury, if we can really transform our Treasury to ensure that it takes care of all the emerging trends, that it is scalable and flexible and ready for the future, then how can it deliver us what we want from it? Which is, and I said this before, it's not just about how much money we make, it's also about how we make the money. Are we tapping all the avenues? Are we ensuring we've got all the cost elements covered so that we reduce cost while at the same time improve profits? Let's look at this in a bit of detail. Now, the first way we can actually help to increase both top lines as well as bottom lines is through something called revenue accelerators. Now, this really talks about maximizing trading profits. Can a treasury system help a dealer to maximize trading profits? Yes. It won't recommend a trade, but it can certainly help with certain analytics, simulators, scenario analysis. It can also help with portfolio benchmarking. So, a whole list of simulators, analytics that can help a dealer to facilitate the decision. It cannot make the decision, but it can help to make the decision. Now we come to an interesting part, and that is channel based income. There's a lot of interest in this space, again, because it focuses on flow business. And there are two elements to it. What we have found out is that by offering digital FX rates to your corporate customers directly, the bank can improve its revenue by approximately 2.6%. And the same applies to branch FX margins. Same logic, disseminate FX rates again to the branches, and you will see margins rising by up to 5 basis points. And we move to a more interesting area, which is intraday liquidity management. Again, our analysis is that digitalizing your treasury can help you reduce your requirements by up to 25%. And this, in turn, will increase your investment opportunities. It will also reduce your funding cost with what we call as just-in-time funding, the ability to fund as and when you need those funds. We come to the second part, which is all about capital leverage. And this really talks about regulatory reporting and regulatory compliance. So we have to ensure that when we digitalize our treasury systems, we are also in sync with the rules of the land or with the law of the land. So regulatory compliance becomes very important. Can the system give us the data that allows us to comply with both internal as well as external regulations? So internal compliance reports, external regulatory reports, all that should be there. We should have your capital adequacy ratios. You should have your stress testing. You should have value at risk. But the most important thing, other than having these different types of functionalities, are these functionalities capable of scale? As the number of transactions increase, can the system, assuming that it is sized correctly for infrastructure, can the system then provide you with the same amount of seamless front-to-back performance? And we come to the last part, which is what this was all about, digitalization of treasury. Now, everyone is looking at automating the entire front-to-back process. So we look at straight-through processing, and anything less than 95% is going to make it difficult for a bank to fully automate its process. Full automation is a dream. There will always be some exceptions where a dealer may have to manually input a deal. Some manual intervention is required. But the most important thing is that from the front to the mid to the back, the entire process should be seamless and it should facilitate easy decision making. Let's take an example, the back office. There are so many different processes. You have reconciliation, you have settlements, you have netting, you have accounting. All of these are very, very important. But can all of these be put into one single screen without a drastic change in code? One single screen that allows the back office user to very quickly pinpoint what process he wants to check and how to make changes to the process. Now, that is what digitalization is really about. Very simple optimization of screen space, but ensuring that all the necessary requirements for a back office user are met within that screen space. Now, what does this do? I mean, digitalization is all about technology. It helps you to reduce your implementation timelines. It helps you to reduce your overall cost of ownership, which is what we call as TCO. And most importantly, because it leverages the latest technology, it leverages the cloud, it leverages APIs, it leverages all the emerging trends that we have spoken about, it can also help the bank to decide where and how it can maximize its profits and minimize costs. So that brings us to the end of this discussion and dialogue. I want to say thank you once again to each and every one of you. I hope you found this useful.